how do millionaires manage their investments and how much money do they put in each of those investment buckets? Most importantly though, how can we learn from this? Let's go ahead and break it down. Now, there are a few things that are really important to lay out here on the table, but first I'm going to give you a little bit of background like I always do. Before doing this here on the YouTubes, I was a financial advisor. I managed over $140 million. I say that to give you some context. I saw these people often. I helped them to choose what investments, met with them, talked about their goals, their issues, their problems, helped them to simplify their investment strategies. How I got good at explaining things and helping to help you find good stocks, which is why we are also here. So this data that I'm going to give you, which is from the National Bureau of Economic Research, these are also the people that tell us whether or not we are in a recession, but it's something that they have researched, but it's also something I have seen because I got to see these account balances. Okay, so it's something I've got to, again, verify and to have them, because I only get to see but so many people, right? And what I saw, and just primarily in New York, is not every millionaire in the world, clearly, and not every millionaire in the nation. So they have broader data than what I physically saw from my own clients across from my desk. So it's very interesting. So I'm going to give you the data that they had, and again, these are averages across the board, and then give you my commentary behind it. So again, it's how they are distributing their money. So let's say they got $1 million, how are they dividing it up? And there is one assumption I'm going to make based on the article that I read. So what they have is their net worth is over $1 million, excluding their home. So they're not counting their house in this $1 million figure. It has to be $1 million and up. 20% of their net worth is in cash. So if we're just capping at $1 million, it means they have $200,000 in cash. That absolutely does make sense. At one point in my career, you had to have $250,000 to come talk to your boy. Yeah, we used to look at people's bank accounts and sort them by the amount. Now, it feels uncomfortable, which is one of the reasons why I left that job. But we would be able to sort everybody in the bank branch and, flip it by amount. And if you had $250,000 and up, I would give you a call. And if you didn't, you would not get a call. That's how the job worked. Now, again, that made me feel uncomfortable. I didn't like it. I feel like people needed advice regardless of where they were. And the people who didn't have that money needed the most advice. Anyway, we can do a video and a rant about that later. Anyway, 20% of their money is in cash, which is interesting because you feel like you want to invest as much of your money as possible. But again, if you already got $1 million, you're already there, and you want some of that money to continue to be liquid. Only 4% of their money is in bonds, which is interesting. Those are more conservative investments, more passive income, but only 4% on average of their money is in bonds. So that was something that was a little striking for me. I did do a lot of business in bonds, meaning there were a lot of clients that came to me, hey, what can I do to get more interest here, easy money, passive income. So there were a lot of clients, but I guess looking back on it, it wasn't like put $400,000 or $500,000 in bonds. It was usually like $50,000 or $60,000. I think the biggest order I ever did was $100,000 in bonds. It was never hundreds and hundreds of thousands. So I guess it does make sense looking back on it. Now here's the biggest chunk, which I'm sure we all thought about. On average, about 53% of their money was in stocks. This is very important. Okay, obviously you want to have a good chunk of your money in stocks. Also remember that the average millionaire is above 60. I mean, the millionaire next door will tell you that, which I'm sure is in the background. Well, you guys can't see it. There's also an updated version. It's probably one of the best books data-wise on millionaires. But this is The Next Millionaire Next Door by Thomas J. Stanley and his daughter, Sarah Stanley Finlaw. It talks about all the data behind millionaires as well. Yeah, I would highly recommend that if you really want to get into the data and psychology around millionaires. But 53% of their money is in the stock market. Even as you get older, I would say about 50%, 50-50, 50 in the stock market, the rest in cash and or bonds, whatever machination, whatever combination you wish, because you want to have that money still moving and you want to have something that is stable and liquid, cash and bonds. So it absolutely makes sense. Now here's where things get interesting. And this is where I would say the thought of the legend of what we think millionaires do and where social media comes in, and then what actually happens. On average, only 6% of their money is in real estate. This is excluding their home. Excluding their home. Only 6% of their money is in real estate. That I found was interesting. Now, we have this theory in our heads, especially in the US, where if you want to be a millionaire, you absolutely have to own, property. Now, owning your home, that's one thing, okay? We can set that aside. But we feel like there are a lot of people and feel like millionaires own several properties, and it's always through real estate that millionaires got it through. When in reality, it's more so through the stock market, clearly 53% of the time. I know it's not how the data works exactly, but you guys get it. Based on the data, more of their money is in the stock market, and only 6%, single digits, is via real estate when you exclude their house. Because that is how, when there are certain types of investments where you must have $2 million in net worth or more, they always exclude your house. They always exclude your house. You have to be what is called an accredited investor. We're not counting your house in this because that's almost a cheat code, because you're just counting this giant asset that you haven't even paid for because your mortgage isn't paid off. We just think rental properties and all this kind of stuff, like, that's not really, it is a way. It is a good way to build your wealth, become a millionaire, but it's not really what happens in real life as often as what we think. That is a social media thing. That's a TV show thing. That's not reality. It's mostly 401ks, mostly people who worked somewhere and had like company shares that they got for very cheap, worked there for very long, or worked there for a while, and those shares made them quite wealthy. That's how it happens. So stock market, real estate is just 6%, cash at 20%, bonds at 4%, and that's where the data stops. Now, I did some quick math. I'm like, it's like 83%. It doesn't give us, all of it. So this is where the data kind of breaks down and people just have, kind of enter into a blank. And then that's where the book comes in, because what you find in this book and then in the original Millionaire Next Door, they show that business ownership is where a good chunk of people become millionaires and where their money is invested. And this is where my experience as a former financial advisor came in as well, because I would say, this is my experience. Okay, there are plenty of financial advisors that specialize in different areas. I was in New York City, so there are different experiences, different parts of the country. But, people, whether it was a dentistry office or a pizza shop or what have you, they did have way more money than the average, quote unquote, millionaire. In that somebody working in corporate America, someone who had a business. And that's not to say that one is better than the other, but the person who had a business, you could sell off that business, and then also they just generally made more. Again, I was in New York, so that could have been a different factor as well. But by having that was also an asset that they could sell off, again, because depending on how well the business does, obviously not every business does well. Let's say you got a pizza shop, you've been doing well for 20 years, a bike shop that's done well for X amount of years. You sell off the entire shop to some venture capital person that wants to take it to the next level, or a restaurant that you've been doing well for a while, you sell it off to some business that wants to, take it over, take the recipe and have 5 or 6 locations now. You can make a lot of money by doing that. I had one client that sold her little website business. I say little, it ain't little no more. But she said she was coming to a lot of money. She at one point had like $300,000, and I think sold her website and I ended up seeing it in the news, like 10 or 15 million. Yeah, and that's not the only time that's happened. Not the only time that happened. So I've had 2 people that has happened to, where they started something sold it for millions of dollars from business ownership. Now that is not common. That is not common. Being a millionaire isn't necessarily common either, if we want to be honest around it. But business ownership is something that takes up a good chunk. Now, that is not within the National Bureau of Economic Research. That's not in the article that I saw, but those are the primary categories. Now, here's the thing that you need to know. Where you are today, depending on your age, like if you're in your 20s or 30s, I don't necessarily think that 20% of your entire net worth needs to be in savings right now, okay? I think you need to figure out what your asset allocation needs to be, and if you are working up to that, you need to kind of either follow the rule of 120, take 120, subtract your age. That's going to tell you that number right after 120. It's going to tell you how much you need to put into the stock market. The rest is going to be between bonds and cash. And that is because we don't know what their income is. They may be making a lot more than us, right? And that's going to make it easier for them to invest a lot, have a ton in all these other areas. Where if you're making $40,000, $50,000, $60,000, a more normal salary, that's going to be much different. Also, there are a lot of millionaires who never made $100,000 either. So there is a balance here. But I will tell you this, for millionaires that I have worked with and millionaires that have been researched in these books and other places, usually they hit that mark and then start to make those changes. For example, they'll hit that mark, they'll sell the business, okay? They didn't start with 20% in cash. They sold the business, kept 20% cash, and then did all those other things. So it's not like they had 20% cash their entire life, right? They were investing, doing all those things, and then I'm retired, I'm doing these things, I'm keeping this 20% and then doing everything else. Okay, so the learning point here should be you don't have to focus everything on real estate right now. You can if you wish, but you don't have to be a real estate mogul to hit the millionaire mark. You should absolutely focus on the stock market. And you absolutely want to take your time as well. And then also, you don't have to make $200,000, $300,000, $400,000, $500,000 to hit there either. But if you can, please do. Right? That is obviously going to help you as well. So that's just some of the behind the scenes things. But if you want to know more, I am open to talking about my experiences, other things you can learn. I also teach a class on your first six-figure investing plan, on some of the things I've learned as a financial advisor and how to work backwards to get your first six figures as an investor and why that number is so important and how that can help you to get to that million. But you got to hit that first $100,000. I'm telling you from experience, not just from working, but from my own experience of hitting six figures and beyond, what you need to do to get there and how fast you can hit 200,000, even 3, and getting close to 4, what that experience is like and how you can start to get there. Because when I started investing, I was making $45,000 as a teacher. Okay, so I didn't have a whole bunch to invest, but I did have the skills. Okay, I had the structure. So you can do that as well, making that or even less, but you have to have the tools. So if you want to know what those tools are, make sure you sign up for the course here. Also, we have a members only where you get access to videos like this early, and these are the people who support the channel. So that is it for today. I will catch y'all next week.